In stock investing, we want to find opportunities where the greater market overreacts negatively to a company, causing its price to eventually become significantly undervalued. It's possible that an opportunity has presented itself with Lumen Technologies, ticker symbol LUMN. Today on Stock Shock, we'll discuss what Lumen is, how their business is doing in detail in hopes of saving you the time of whether you want to do a valuation on them for yourself or not. And just for fun, we'll find out what is the current highest non-REIT dividend yield in the United States stock market today. Once upon a time, there was a mediocre company that provided mediocre phone services and cable services and broadband internet ran by mediocre management. This company was called CenturyLink, the third biggest landline telephone company in the United States. Since the only one left using home telephones and watching cable TV these days is your great-grandmother, you can imagine that revenues and profits from CenturyLink's core legacy services have been flat to down over the past several years. Those are only expected to get worse as these customers move on to updated technologies and discontinue those legacy services or discontinue their existence on this mortal plane. Thus, the stock price continues to suffer as analysts in the 2010s care mainly for sexy growth stories and not about a no-growth snooze fest of a company like CenturyLink. Around 2016 to 2017, CenturyLink announced a buyout of a company called Level 3 Communications, and that's going to be key to the entire picture of what Lumen is today as a whole. And it greatly increased their exposure to the better technology of fiber internet. Level 3, by most investors' accounts, also had much better management. Level 3 makes money by providing fiber connections for other companies. Let's say you're on a conference call with another company in another country, and those companies don't have lines that extend between you and the opposite company you're talking to on your conference call. Well, then Level 3 would provide that connection. I would call this more of a merger than a buyout because CenturyLink stockholders ended up with around 51% of the company and Level 3 stockholders with around 49% of the company. Unlike CenturyLink, Level 3 was still organically growing at the time, but it also had $10.9 billion in debt that they brought to the marriage. Now that, combined with CenturyLink having to borrow for the acquisition in the first place, resulted in this massive debt jump that you see here in their financial statements between 2016 and 2017. When this combination happened, Jeff Story, who was the CEO of Level 3, became the CEO of the new entity by popular demand. And I don't mean that as a turn of a phrase either. The vast majority of shareholders in both Level 3 and CenturyLink demanded, essentially, that Story be the one to head the new company instead of the previous CenturyLink CEO. So as often happens in my experience with major mergers like this, things got overblown. And Jeff Story, came out and made a big hoopla about this is a new company now. We are no longer your grandma's CenturyLink. We are a new entity and we will continue growing into the future. And they kind of sold this growth story to Wall Street as a whole that since then hasn't proven to be true. In 2020, they rebranded to Lumen Technologies, in my opinion, to further distance themselves from the words CenturyLink, and hoping to get investors and analysts to look at them in a different light. But so far, as you see from the stock chart, it doesn't seem like anyone on Wall Street has fallen for it. So with all that history said, what is Lumen now? What's the current situation? Well, over the years of laying wire and through acquisitions like the Level 3 acquisition, Lumen has amassed 450,000 miles of fiber network, taking advantage of a lot of tax subsidies along the way, which many experts say it would take a new company 3 to 5 years and hundreds of billions to recreate these assets. In particular, Level 3 had amassed a lot of subsea fiber, which is very expensive to reproduce. It's also going to be continually harder for companies to receive tax subsidies for laying wire like Lumen did during the optimal years. And in some spaces like rural America, for example, it doesn't make as much sense for another company to lay cost-intensive assets in those areas where Lumen has already done all the work and there's not a whole lot of juice to squeeze out of these smaller populated areas. This provides revenue based on a wholesale connectivity, quote, toll road, wherein every year a toll is required to be paid by other companies to travel Lumen's fiber highways. And through each year, the toll is charged. It does get a little cheaper and cheaper, but it's still dependable revenue for Lumen. You could argue that this is strong enough to be considered a toll road type of moat if you wanted to. I wouldn't quite call it that, but I wouldn't argue with you if you did. Now, 5G is a sure way of continuing free cash flow for Lumen, in my opinion, and they will continue to have to compete with other 5G players in this area. However, they already have all of this fiber laid out, and that line will need to be laid out by a lot of these competitors. In fact, Verizon, one of if not the biggest player in the 5G space, actually currently pays Lumen to use Lumen's connectivity. With other new trends now in play, like Internet of Things, data, AI, robo-factories, robo-surge, autonomous vehicles, all of these needing fiber internet in some capacity, Lumen has numerous ways of continuing to produce cash in the future. But again, the voice business from CenturyLink is slowly dying. No one wants home phones anymore. As I showed earlier from their recent 10K, Voice lost 14% operating revenue from 2018 to 2019. Then it lost 12% the next year. And then quarter one of this year, it was down 8.6%. They also have some cloud services. They have like 300 to 400-ish data center assets. And they can partner with the likes of like Amazon Web Services or Azure to take some of their extra load at times. And then they'll also, some businesses, they don't want to fully commit to one dedicated cloud service like AWS or Azure. And so they get some revenue from those kind of businesses. Their main moneymaker, though, is the fiber. Now, thankfully, total addressable market for fiber continues to grow. As we mentioned, 5G helps with that. And COVID has actually expedited that quite a bit. The average usage per household has gone up 200 gigabytes in 2020. Around 71% of Lumen's revenues are enterprise and around 29% is residential in quarter one 2021. Now, bears will argue that both of those will continue to slowly decline, even the enterprise segments, because they're going to continue to face more and more competition, and companies now have lots of great options that they can turn to aside from Lumen, and some of those providers offer newer tech that Lumen doesn't. Still, with that said, after my research, I kind of feel like that's probably Lumen's best bet for future growth is the enterprise side of things, particularly in the very large Fortune 500 companies in the United States. Because with all of Lumen's fiber infrastructure, plus their other services that these large companies may still need in their physical locations, like voice, data, broadband, cloud, etc., Lumen provides all of that, at least for the next several years, which could give Lumen somewhat of a switching cost moat in the short term at least. And again, I don't know that I would personally consider strong enough to be a moat, but I wouldn't argue with you if you did. Now, right now, those large enterprises are about 35% of that total enterprise pie. On the management side of things, as always, management is often kind of like each investor's perspective kind of thing. But to me, it seems like Story's doing a pretty solid job. He became CEO around end of 2017, shortly after the merger or acquisition, whatever you want to call it. And I think it's only fair to judge him based on the full year 2018 numbers and moving forward. Now you can see the free cash flow from 2018 to 2019 grew, even though CenturyLink lost 10 to 12% of revenue. So they lost revenue, but he still increased free cash flow. He also did what he claimed he would, and he put the focus of the company on paying down that massive mountain of debt. He managed to do this by better usage of capital expenditures and by saving on interest expenses by paying off so much debt and restructuring debt. And this has helped Lumen increase their margins at a very solid pace. It's also smoothed out their debt maturities in favor of a more steady approach. They don't have as many giant debt cliffs upcoming as they did when he took over and started focus on this. They've avoided an upcoming cliff that they were going to face in 2027. They've continued to do this even this past month. They took out $1 billion in debt at 5.375%. That's due in 2029 in order to restructure a debt that was due in 2021 at a 6.45%. What this does, if you continue to do it like they have been doing, is it essentially creates a snowball, whereby if done correctly and continually, Lumen can continue to restructure debt at lower interest rates, save money on interest expenses, take that free cash flow that's now freed up from saving on said interest expenses, and use that free cash flow to further pay off and restructure more debt, and so on and so forth. So as long as they stay focused, they'll continue to get results from this. Now, there is a limit to how long you can increase your margins like this, because if you kept doing it ad nauseum, eventually all of your debts are now going to be at those lower rates, and restructuring no longer is really worth the time and the money. Or if the macro environments would increase interest rates, like maybe a Fed that forgot to turn off the money printer and now needs to raise rates a couple years from now, you can no longer be able to restructure those debts at lower rates. And then lastly, let's touch on their dividend, because they do have a sizable one. It's currently $1 annual per share, which is 60.74% of net income, but only about 33% of free cash flow, which is the metric that actually matters. So they can definitely afford it now. I emphasize now because it has been cut before. The dividend has been cut twice in the past 10 years. Because with all that debt, they honestly couldn't afford such a massive dividend back then. Now, however, the dividend is very manageable. Now, you wouldn't, in my opinion, want to invest purely as an income play, since while they can afford the dividend, it obviously isn't a top priority with them with this past history of these massive cuts. Regardless, though, right now, it is around a little under 8% yield, like a 7.9% yield, depending on what day you're watching this video. Now, looking back at 2021 quarter one, let's look at the div yields and see how they stack up. They do make the top 10 in the United States, but there are a couple of changes that we could make here. We all know that Carnival Cruise Line hit the COVID iceberg and their dividend went the way of the Titanic. And then AT&T is doing some new merger that, in my opinion, doesn't really make a whole lot of sense, and they've slashed their dividends, so they can be marked off this list as well. So Lumen kind of slides into third place of the S&P dividend yields. So to summarize my observations so far, we have a ton of fiber and broadband infrastructure. We have some room for small growth in data, cloud, and edge, particularly in the large enterprise area. Again, just my opinion. And they still have a solid amount of cash flows, and they're currently trading at low multiples, which we'll show here in just a moment. They have some synergy with sector trends. They have a possible price catalyst if they could sell some of those legacy assets from the very old CenturyLink days and use that money to pay off these large chunks of debt that they have, and or to pivot more into focusing on fiber and focusing on those large enterprise services. Management has been improving the debt, and therefore the margins have steadily increased, and they claim that they will continue to focus on that. However, we still, at the end of the day, we have an outright dying voice and cable service, a metric ton of debt, declining overall revenues, increasing competition in the fiber industry, and not really a solid moat to shield off any of that competition. Now, the margin expansion from those interest expenses, as we mentioned earlier, is also something that, while it's been useful and helped them expand those margins, they've already restructured a whole lot. There's only so much farther they can go, because eventually they won't have any remaining ones that are worth restructuring, and or the US Fed will finally pull their head out of their own cheeks and raise interest rates before Lumen can finish doing all the restructuring that they want to do. Moving on to valuation. First, let's look at roughly how they are priced in the market today. Their EV to EBITDA is 5.38. Their PE is unreliable because with their high depreciation costs, they actually have a negative PE. So let's instead look at their price to free cash flow, a metric I personally care more about anyway. That's at 4.17, very low. Even though they're declining, they're only declining in revenues by around 3% a year, as what we were talking about earlier. So a 4.17 is pretty dang low of a multiple. And price to sales is 0.67. You can actually see here from an investor's presentation last year where Lumen does their own math and kind of shared with their investors where they feel they should currently be valued. Now on it, they're showing how much of their EBITDA comes from level 3 assets and how much of it comes from CenturyLink assets separately. And then they apply a multiple to each of those individually that they feel those specific assets and their respective cash flows should trade at. And that's how they come to their fair value assumptions there. Here at Teaching Wealth, I take the stance of never telling anyone what to buy or when, even to my friends and family members. I only want to share these ideas with you in the spirit of, hey, here's something potentially interesting. Here are the numbers. Here's my personal opinion. Maybe you can do some digging and see what you come away with for yourself. So I'm not telling you to buy this stock or not to buy this stock. I will tell you my assumptions that I gave in my models and why I gave those assumptions, what my fair value ended up being, and what margin of safety I would personally want to invest in the company. Again, not to tell you when to buy, more just to share with you my personal process and approach to investing. I'm going to show off Everything Money's new stock analyzer tool here because I really actually like it, and if you haven't already checked them out, go give them a follow and a subscribe on YouTube and see if there's anything you can learn over there. As much as we as investors want to always feel like we found that diamond in the rough, with Lumen I think I have to stay disciplined and just go with my head here. I'm not buying this whole growth story one bit, and in my valuation assumptions, I have my normal case as them declining in revenue by negative 2.5% into perpetuity. Lumen expects that the CenturyLink side of their business will continue to decline at around 5% revenue yearly. I don't anticipate them being able to offset those losses by having enough growth in the fiber world with all the competition we mentioned earlier, with no moat, in my opinion, and a mountain of debt still weighing those margins down. With those things being the case, I don't think Lumen will have enough free cash flow left over to create enough shareholder value through dividend increases, buybacks, divestitures, whatever, to really be able to convince Wall Street to give them these multiples that Lumen and their investors presentation feel they should deserve. The debt has been improved, and I can appreciate and applaud that, but it is still extremely worrying to me and should still continue to weigh down their margins for quite some time. I felt most comfortable with a 3% margin for them overall. Now, one note I need to make about the share assumptions for them is, as you can see here on Everything Money's software, it's showing this really high share increase rate. But there's something that we need to understand about that, because this software is just telling us the cold hard facts. It's up to us to do our own research into the exact details of the company when we go to make our own assessments here and make our own valuations, in order to give the most accurate numbers in our assumptions here that we can. Their increase over the past 5 years, as you can see here, is 19% annual. However, it's critical to realize that when the merger happened, the share count doubled. That was a one-time thing. If you look over the last years in the past decade, they've bought back shares or been basically flat pretty much every other year. So my assumption for them moving forward is a balance between very small buybacks, which they've mentioned once or twice in their investor presentations and in their earnings calls. A balance between small buybacks and then management stock options and things like that increasing. So I gave it a flat 0. Now, with Lumen currently having negative net income, primarily because of those large asset depreciation write-offs, I think it's cleaner to just use a DCF model for them. I used the desired annual return of 10%. With those assumptions in place, my fair value calculation for a normal valuation case for Lumen was $17.87. It's at this point that I need to establish my margin of safety. Bulls will constantly refer to the possibility that Lumen can make a huge asset divestiture to remove some of these declining CenturyLink assets, and then the remaining level 3 assets will have enough growth potential to give the new Lumen attention from Wall Street and investors, a shrink to growth theory, if you will. I'm not ruling that out as a possibility. However, with the way the stock has traded over the past several years and continues to trade now, aside from this quick little short squeeze we had in early 2021, I feel like I can always reassess the company post possible divestiture and make an investment decision at that time once I have all the actual details of said divestiture and I can actually run the math and run the numbers and make a decision for myself. I'm not going to let fear of missing out on a potential share spike on divestiture news day rush me into buying a company that I feel I don't need to be in a rush to buy. Overall, to me, Lumen, it feels like a value trap. It looks like a value trap. It smells like a value trap. It might be a value trap. With my spidey senses tingling so intensely, I want to give them a large margin of safety here, so I'm going to go with 40%. Now that would give me a buy price of $10.72 personally. Now with Lumen today trading around $12.50, that's close enough that there's probably potential to sell puts that will pay me to wait for that lower price. For example, if I could sell a September 3rd put at an $11 strike for this spread midline of 15 cents per share, that'd be a break-even price of only 13 cents above what my 40% margin of safety would be. And it would give me an annualized return of 15% and a likelihood of being filled of only 17.6%. To me, in my personal investing strategy, this is an ideal options play for me. If the put doesn't fill, then I just made 15% annualized return. And if I do get forced to buy the shares, my cost basis is going to be $10.85, which is almost 40% margin of safety off of my fair value. And I got that fair value using rational assumptions in my calculations. Again, this isn't to tell you what to do or how to do it. I just wanted to take some time in this video to illustrate my personal trading plan in hopes that our newer investors or younger investors that often message me or we talk on Discord or whatever, to give you like a visual example of the importance and power of having a trading plan that you know well and you stick to religiously. Develop your own plan, do your own research, make your own assumptions, but no matter how you go about it, make sure you're making reasonable assessments. If you put garbage into your valuation, you're going to get garbage out. And if I assumed, say, that Lumen will grow at 3% instead of declining at 3%, then I'm going to get a fair value $8 higher than what I'm personally getting, and one that, in my opinion, would be too optimistic given this total picture of Lumen's headwinds that we looked at earlier. So if all of this interests you, go check out Lumen for yourself. I'll link several resources in the video description below that I found helpful when I was doing my research. Come to your own conclusions, make your own assumptions, make your own decisions. Good luck in continuing to grow wealth for yourself and for your family.